The spot price for gold is at a record high of nearly $3,500 an ounce and is up close to 30% year to date so far, vastly outperforming all of the major world indices. But should investors be thinking about having an allocation to gold within their investment portfolios? Well, for this video, I've done some research which I wanted to share with you today. It's going to include some academic literature. We're going to talk about the benefits and drawbacks of gold within an investment portfolio. I'll share some of the thoughts of some well-respected investors, and then finally we'll discuss where you can buy it and in what form. But before we do all that, guys, do remember that this video is for educational purposes only and should not be construed as financial advice. Nothing that I share within this video is an investment recommendation. I am not a financial advisor, so if you need personalized financial advice, please seek out the help of a qualified financial advisor. Gold has been a symbol of wealth and status which has lasted for centuries, from it being used as a currency as early as 550 BC, and there was even a gold standard up until 1971, which linked the value of a dollar to a physical amount of gold. More recently though, over 50% of gold is now associated with things like jewelry and watches, and even toilets, providing a whole new meaning to the bathroom throne, with prices into the millions if that's your thing. And whilst it can be used for those seeking out the finer things in life, many professional investors, hedge fund managers, and even academics believe that it equally stacks up just as well as an asset class that should be considered as part of any investment portfolio. So let's talk about why by first discussing its unique characteristics.
I love gold!
And many investors love it too, right? Because for one, it's a store of value. But let me explain why that's so important. One of the biggest financial threats that we all face is the devaluation of our domestic currency. In the UK, we're actually quite lucky because we have what is the longest standing currency in all of existence, which is the Great British Pound. But that British Pound has vastly devalued over time thanks to inflation and increasing money supply in order to fuel government debt. However, for a better perspective, let's use the Bank of England calculator and actually work out what £1 worth of goods would be in 2000 versus what it would cost today, which is £1.87. That means the UK public would have needed at least an 87% return on their cash since the year 2000 just to keep up with the rate of inflation. So whilst currencies typically devalue over time because central banks can just increase the money supply by printing billions if not trillions of pounds worth, gold in fact is quite the opposite because it's a scarce resource and therefore limited in supply, with some experts suggesting that we'll actually run out of gold to mine as early as 2050. If that's therefore likely and there's still underlying demand for gold as an asset or resource, providing that there's a limited supply and there's still demand for that gold, then in economic theory terms, then prices should still increase. And that's largely congruent with what we've seen with gold prices throughout the course of history since like the early 1800s. But of course, nothing is guaranteed in terms of future performance. Now, it's also worthwhile me pointing out, and we'll touch upon this in a little bit more detail when we get into the research, but gold prices over periods of years and sometimes over a decade have actually declined or stagnated, which should be a consideration here. In addition to this, another unique characteristic about gold, as it says in the Economic Observatory, is that there is a long-standing idea that gold provides a safe haven or a hedge against inflation, which is what we've already discussed. A safe haven, though, is a long-term investment that's expected to retain its value or even increase in value during times of market turbulence. Now, that market turbulence can be brought on by political, geopolitical, and economic uncertainty, like we saw with the COVID pandemic, like we're seeing with the Russia-Ukraine war, even with Trump coming into power and causing turmoil because of the tariffs which he's looking to impose. And the academic literature largely supports that kind of underlying performance of gold when markets are volatile, along with a few other elements too, which are also important to consider as an investor. So let's talk about that next. There was a paper written in 2024 called The Role of Gold in Investment Portfolios, which looks to explore gold's historical and quantitative significance in diversified investment portfolios. A little bit of a mouthful, I know. And within the paper, it shares 7 different scenarios and compares the relative performance of different asset classes during that period of time where the conditions of the scenario were met. Now, whilst I'm only planning to share some of the most interesting ones for me today, what I will do is I'll leave the report down in the description below, which you can check out at your leisure. So firstly, let's jump into scenario number 2, which is when equities are in a bear market. Now, a bear market is where the stock market has declined by 20% or more, and that's happened on a handful of occasions during this 50-year data set between 1973 and 2023. Some of the notable ones include the COVID crash of 2020, the financial crisis of 2007, the dot-com bubble of the early noughties, and the Black Monday 1987 crash, along with a couple of others. And during those linked periods of time, the study shows that whilst equities were down by 33.36% on average, gold was actually up 21.36%, with other commodities, treasuries and cash all providing positive returns. This data showing us that in bad times for stocks, actually gold on the other hand retains its value if not goes up in value, and as a result can mitigate some of that downside risk within an investment portfolio. Moving on to scenario 6, where inflation is high, which is where we have a sustained increase in prices, which the paper has defined as when inflation has exceeded over 4.01% over the study period. So that takes into account, I guess, more recent times like in 2021 and 2022, where the US inflation rate was 9.1%, and over here in the UK, it was even slightly higher. We were into double digits at one point in time. And in the report, it concludes that gold returns were up 10.32%, whilst equities were up 4.18%, with treasuries, commodities, and the dollar all providing positive returns too. Actually, the report doubles down on that most recent inflationary spike, which actually states that gold returns during that period were actually 16.16%, whilst equities gained 8.8%. It also highlights that that store of value argument is certainly prominent. And as our purchasing power continues to decline because of inflation, as at this report, gold invariably holds up strong. And as at the most latest instance, at least it was an adequate hedge against inflation. Then finally, let's move on to scenario 7, which is where market volatility is high. They've defined market volatility as where the VIX index is in the top quintile of its 34-year history. I shared some information around the VIX on a recent video, which I'll leave in the description. But for context, the VIX is a measure of market volatility. Without going into too much of the detail here, you can just visually kind of see the correlation where the VIX index has spiked like in 08 and 2020 and even 2025 to an extent. The market usually has a little bit of a wobble during those periods of time. And again, this study shows where volatility is high that gold performs at 11.98% versus equities at minus 22.47%, treasuries at 5.74%, the dollar at 0.81%, but commodities on the whole, interestingly, being down 7.52%. This very much highlighting those qualities and credentials that gold is traditionally associated with as being a safe haven asset during times of market volatility. But just to bring this back towards more of a holistic view, so we're looking at the bigger picture here over that set time period of this study, actually if we look at the average annualized returns of each of the individual asset classes, we can see equities is still the standout performer at 10.66%, gold at 7.01%, and treasuries at 6.05%, which based on what we've just discussed is why gold could be a consideration for an investor's portfolio. Not just for the qualities that it has, but for the risk-adjusted returns that it can offer. Now, a risk-adjusted return within an investment portfolio is kind of like saying, how much return am I getting for the risk that I took? And as an investor, it's always a little bit of a balancing act between optimizing the upside, but also limiting somewhat of the downside risk. And gold can act as a little bit of that balancing act within an investment portfolio's risk to reward profile, as we can see in figure 17. But obviously there's consideration here towards allocation, because allocate too much and returns reduce. Allocate too little and it might not have the desired level of risk mitigation. So with that in mind, now let's dive into the insights of some of the most legendary investors on the planet, starting off with Ray Dalio.
There's no sensible reason not to have some, if you're going to own a currency, if you don't, it's not sensible not to own gold. Now it depends on the amount of gold, but if you don't own, I don't know, 10% in if you don't have that, and then depends on the world, then there's no sensible reason other than you don't know history and you don't know the economics of it.
Whilst this interview is now well over 10 years old, Ray Dalio has been a strong advocate of holding gold as a small portion of an investment portfolio since the late 90s. And that's ever since he launched the infamous all-weather portfolio back in 1996, with the fund's objective to be resilient across a wide range of market conditions and environments, including economic contractions and elevated inflation, of which the traditional allocation within this all-weather fund portfolio towards gold has been 7.5%. And it's something that Ray Dalio wholeheartedly stands by. But those views on gold aren't held by all professional investors, and that's because gold does have some inherent drawbacks. So now let's kick off the opposing view by none other than Warren Buffett.
If you buy an ounce of gold today and you hold it 100 years, you can go to it every day, and you can coo to it, and you can caress it, and you can fondle it, and 100 years from now, you'll have 1 ounce of gold, and it won't have done anything for you in between. If you buy 100 acres of farmland, it will produce for you every year. You can use that money to buy more farmland. You can do it, all kinds of things. For 100 years, it'll produce things for you, and you still have 100 acres of farmland at the end of the 100 years.
What Buffett's getting at here is that gold is a non-productive asset, in the sense that it doesn't generate an income, it doesn't provide a dividend to shareholders, and it can't really do anything. Sure, it has some real-world use cases that we discussed at the start of the video, but as an investment, it's not like investing into a business which can generate profits and those profits be reinvested to grow the value of the business and also make more profits for shareholders too. And instead, the value or the price of gold is purely based on the demand for it, which I guess raises questions as to whether it can maintain that reputation as a store of value, or even if it's the best store of value out there. Goldman Sachs wrote a report which was called Digital Assets: Beauty is Not in the Eye of the Beholder, where they look at different asset classes' historical frequency of outperforming inflation. And as you can see from this research, gold actually performs less well relative to other asset classes over anything less than like a 20-year period. But it does become better the longer that time goes on. And just like I referenced earlier, there's been periods of time where gold hasn't performed well whatsoever, which I guess raises a question as to whether it's actually a good choice for investors or not. Fundamentally, like with any investment, they all have pros and cons, risks and rewards, and it all comes down to an individual's personal risk appetite and investment objectives to decide how they want to build out their investment portfolio. But now let's discuss how you can actually buy gold, because there are a couple of different options available. So option one is to purchase the physical stuff and actually have the gold coins or bars at your house or wherever you want to keep them, somewhere safe. And you can do this through websites like the Royal Mint. This is in no way sponsored, and there are other websites available if you just give it a quick Google. Now obviously there's some challenges there if you end up buying a sizable amount of gold or a big gold bar, in terms of where you're going to keep that safe within your own home. Now, an interesting point on this: if you actually buy gold coins, as it states on the website, these are free from capital gains tax. And that's because it's considered as legal tender, and technically currencies can't be charged by capital gains tax on their appreciation. So that's just something to know. However, gold bars, on the other hand, are subject to capital gains tax, because these technically aren't legal tender. The alternative option to avoid having a big vault secured down to your house and to avoid paying tax as well is to buy something called an exchange traded commodity through a tax efficient account called a stocks and shares ISA. These exchange traded commodities are available on quite a few different investment platforms, but not all of them, so be sure to make sure that you go and do your own research. But some of the funds that I've come across are the iShares Physical Gold ETC, the Wisdom Tree Core Physical Gold ETC, and the Invesco Physical Gold ETC. Now these funds aren't recommendations, these are just the funds that I found on the commodity category on the trading platform which I personally use. I guess one of the only downsides to having an ETC is that you then have to pay somebody to manage that fund, and I'll flash up a screenshot of the associated fees for the funds I've just mentioned. Overall though, both investments obviously give you exposure to the gold market. It just depends on what form an investor wants to see them in. So whether you're Team Buffett or Team Gold member, the role of gold within an investment portfolio ultimately comes down to an individual's risk appetite and investment objectives. Gold certainly isn't a magic bullet by any stretch, but it can be used as a strategic tool in order to help diversify and protect a portfolio against some of the uncertainties that we've discussed during today's video. Now, if you did enjoy this video, guys, be sure to subscribe to the channel, but before you go, YouTube thinks that you might be interested in watching this video next, so be sure to click on that now. That being said, see you over in the next one.